Two people start their adult lives at exactly the same time. Same graduation year, same first job, same salary. On paper, their financial lives should look almost identical. But fast forward 20 years, and something strange happens. One of them ends up paying tens of thousands of dollars more for things like housing, car loans, insurance, and even basic borrowing. Not because they bought more, not because they lived more extravagantly, but because of a number they barely thought about. A number quietly influencing almost every financial decision around them. And most people never realize just how powerful that number really is. Think about that for a second. Same starting point, same income, same city, same lifestyle, same decade. And yet 20 years later, one of them is sitting on significantly more wealth. Not because they worked harder, not because they got lucky, but because they understood one thing the other person didn't. We're going to break down exactly what that is. Welcome back. Today, we're talking about something that quietly controls the cost of your financial life. Your credit score. Now, most people think of credit scores as just a tool banks use to decide whether or not you qualify for a loan. But that's only part of the story. In reality, your credit score can shape how expensive your life becomes. And sometimes, the difference between a great score and an average one can cost people hundreds of thousands of dollars over time. That's not an exaggeration. This is math, the kind that plays out slowly, quietly, in the background of someone's life without ever sending a warning. Most people only start paying attention to their credit score when they need something, a car loan, a mortgage, a new apartment. But by then, the damage is already done. The habits that shaped that score were built years earlier. And the cost of a weak score isn't a one-time fee. It compounds. To understand why, we need to go back a few decades. Before the late 1980s, lending decisions were much more subjective. Banks relied heavily on human judgment. Loan officers would evaluate borrowers based on income, employment history, and sometimes even personal impressions. But in 1989, a scoring model created by a company called Fair Isaac Corporation started changing the system. Instead of relying entirely on human judgment, lenders began using a standardized numerical score to estimate how risky a borrower might be. Over time, that score became one of the most influential numbers in personal finance. Today, lenders, credit card companies, and sometimes even landlords use variations of this system when evaluating applicants. And the difference between a strong score and a weak one can translate into dramatically different borrowing costs. Take a typical home purchase as an example. Imagine someone buying a $400,000 home with a mortgage. If their credit score qualifies them for a lower interest rate, say around 6%, their monthly payment might look one way. But if their score pushes them into a higher rate, maybe closer to 7.5%, that same home suddenly becomes much more expensive. Over the life of a long mortgage, that difference can add up to tens or even hundreds of thousands of dollars. Let's make that more concrete. At 6% on a $400,000 mortgage over 30 years, the total interest paid is around $464,000. At 7.5%, that number jumps to over $601,000. That's a difference of roughly $137,000. On the same house, with the same down payment, same neighborhood, same everything, just a different credit score. And mortgages are only one piece of the puzzle. Credit scores can influence the cost of auto loans, personal loans, and credit cards. But they can also affect areas people don't always expect. In some places, insurance companies use credit-based models when calculating premiums. The idea is that certain financial patterns might correlate with risk, whether people agree with that logic or not. The reality is that those numbers can influence what people pay for coverage. So too, individuals driving similar cars, living in similar neighborhoods, could still face different premiums. Not because of their driving history, but because of their credit profile. And doesn't stop there. In most major cities, landlords run credit checks before approving rental applications. A weaker score can mean a rejected application or being asked to pay a larger security deposit just to get approved. In some cases, it can push someone into a less desirable area, a worse commute, or a smaller unit. None of these things feel like credit problems in the moment, but they trace back to the same number. Over time, these small differences stack up. Higher borrowing costs lead to larger payments. Larger payments leave less room in a budget. And less room in a budget can make it harder to save, invest, or recover from financial setbacks. This creates what some analysts call a financial feedback loop. People with stronger credit histories often gain access to cheaper borrowing, while those with weaker profiles sometimes face higher costs that make progress slower. And this is where many people misunderstand how credit scores actually work. Because the system isn't designed to measure how wealthy someone is. It's designed to measure how predictable their borrowing behavior appears to be. That means things like payment history, credit usage, and the length of time accounts have existed can all influence the final score. Payment history is the biggest factor. Missing a single payment, even by 30 days, can cause a noticeable drop in someone's score. And that drop doesn't disappear overnight. Negative marks can stay on a credit report for years. Credit utilization is the second major driver. This is the percentage of available credit someone is currently using. Most financial advisors suggest keeping that number below 30%. Some say below 10% for the strongest scores. The length of credit history matters too. An account that has been open for 12 years carries more weight than one opened 6 months ago. This is why closing old accounts, even ones people aren't actively using, can sometimes do more harm than good. But the system isn't perfect. Scores can fluctuate for reasons that confuse many people. For example, using a large portion of available credit temporarily can lower a score, even if every payment is made on time. Closing old accounts can sometimes reduce the average age of credit history. And applying for multiple new accounts in a short period can create short-term drops as well. These changes don't necessarily mean someone is financially irresponsible, but the scoring models are designed to interpret patterns, not personal stories. Because of that, many people feel like their score moves unpredictably. And while there are strategies people use to improve their credit profile over time, it usually comes down to a few consistent habits. Paying obligations on time. Keeping credit usage relatively low compared to available limits. Maintaining long-standing accounts when possible. And avoiding unnecessary borrowing activity. Over long periods, those behaviors tend to produce more stable results. Now, there's also a debate in the personal finance world about whether people should rely on credit at all. Some financial personalities, like Dave Ramsey, argue that avoiding debt entirely is the best strategy. Others believe that responsible credit use can be a practical tool when managed carefully. Both perspectives highlight something important. Credit itself isn't inherently good or bad. It's simply a financial system that rewards certain patterns of behavior. And understanding how that system works can help people make more informed decisions. Because whether someone chooses to actively use credit or minimize it, the rules of the system still exist. And ignoring them doesn't necessarily make them disappear. So what's the practical takeaway here? Check your credit report. In the US, Canada, and Australia, there are ways to access your credit report for free at least once a year. Look for errors. Incorrect information on a credit report is more common than most people realize, and disputing those errors can sometimes lead to a meaningful score improvement. Beyond that, the fundamentals matter more than the tricks. No single hack will transform a credit profile overnight, but consistent, boring, reliable behavior, paying on time, keeping balances low, not opening too many accounts at once, will move the needle over time. And that movement has a dollar value attached to it. At the end of the day, a credit score is just a number, but it's a number that can quietly influence the cost of major life decisions. From borrowing money, to securing housing, to navigating everyday financial opportunities, which means that understanding how it works can sometimes be the difference between paying the standard price for life or paying significantly more for the same exact things.